Business ownership is the best way to build wealth, and buying a business is the fastest way to get there. Now, we had a user ask us to look into hair salons, but specifically, they wanted to know how to value a hair salon. So for this video, we're going to focus specifically on that valuation question. Now, there are two types of acquisitions. One, we are just purchasing the physical assets. There are no employees, there are no customers, there's no brand. There's really nothing else that comes along with that purchase other than the physical items that might have been used to run that business. You are literally just buying stuff. So in this situation, the valuation is based on the value of the stuff. You want to have the larger items appraised, or go and look up the fair market value and take a good estimated guess at the lower ticket items as to what the overall value of all of those assets. And that's fair market value. Now, hopefully you're in a situation where you can negotiate a deal to pay a little less than market value because you have a distressed seller in a way, but that's at least your gauge of what's fair. You don't want to pay above. Hopefully you can pay below. But if you pay fair market value, then you got a fine deal. And then the second type of purchase is what we typically focus on, which is when you're buying an existing business that's currently up and running. It has employees, it has customers, it has policies, procedures, it has a brand. It's a full operating business generating revenue and cash flow today. So, quick side note, from a legal perspective, both types are often called an asset sale. Not to get into the legal weeds, asset sale, think of it as like you're not acquiring the liabilities of the previous owner. There is such thing that's called a stock sale, in which you would be acquiring the liabilities of the business, but that's not common in this particular marketplace that we're talking about. That's typically something you see with much larger corporations. So back to valuation. So when purchasing an up and running business, we typically look at a multiple of the profits that business produces. Now, this multiple can go by a few different names. One is price to EBITDA, earnings before interest, taxes, depreciation, and amortization. There's price to SDE, which is seller's discretionary earnings, price to owner's benefit, or price to cash flow. So SDE, owner's benefit, and cash flow, those are all the same thing. Those are just different ways to say the same thing. We're looking at the cash that accrues to the owner, including their salary. And that's the difference between the price to EBITDA. So EBITDA typically treats the owner's salary as an expense to the business. And we typically add that back because that's a cash flow that when you go and buy the business, it's going to come to you. So it is fair to look at what would we call the SDE, the seller's discretionary earnings, that owner's benefit, or I often just refer to it as cash flow in our videos. And so let's focus on that price to cash flow. Now, honestly, multiples can really vary by brokers. I do personally think that brokers actually underprice businesses on purpose because they just want a quick and easy sale. And it's really common that we see things sell within hours or the first day, which I put my economist hat on. That tells me that business sold too cheap. If a business sells in hours or days and gets multiple people interested, it probably sold at the wrong price. So as a buyer, that's great. You get to go and buy assets at probably less than they're truly worth. But that also means that things come off the market really fast. It makes the acquisition process difficult. I don't know how many businesses I've missed out on that I would have paid 20, 25% more than what they're asking and been completely happy. The numbers would have worked out great for me. But you didn't get the opportunity because the broker listed it on the websites. It instantly had an LOI and poof, it was gone. It was off the market. Now, that said, there are several factors that go into determining multiples. One of the biggest factors is the size of the business. And this is true whether you're looking at Fortune 50 companies or small mom and pop shops. The bigger the company, the higher the multiple that you typically see. And there's a reason for that. Size is a signal of a lot of different things. The larger the business, the more likely they have a more diverse customer base. If you have a business with only one or two customers and one of them leaves, then you're really in trouble versus if you have thousands of customers. That business can survive as a small number of clients leave. So that reduces the risk of the investment. It also means that there's more infrastructure in place so that the more revenue you have, the more administrative overhead that business can support. That means the more efficiently it can operate, and the more likely that business can run absentee. And they produce a better return on time. So sometimes we get questions where people talk about return on investment. So if you look at just what the return on the dollars you put in, but really when looking at the type of businesses we talk about, I think return on your time is something that's really important to consider as well. And basically it's almost breaking it down to, what's the hourly wage that I'm earning by owning this business? So if you buy a business that makes $100,000 a year in net profits, but you're working 60 hours a week, that's really different than buying a similar business with $100,000 in cash flow where you're only working 2 hours a week. So you can have two businesses where your return on your investment may look the same, but in one business you're effectively making about $32 an hour, and the other one you're making about $961 per hour. Second big factor in determining the multiple is the perceived risk of the business. The higher the risk, the lower the multiple. And one way you can gauge this is by business mix. So you may see, let's say, two electrical companies, and let's say one only does new installs and the other only does services. New install is a lot more volatile than servicing. So the company that focuses on services is going to get a higher multiple than the one that focuses on new installs because you're constantly having to sell your products. There's a lot more risk to that business model. The third key driver of valuations are contracts. Anything with really long-term contracts in place with good counterparties is going to trade at a significantly higher multiple. And that's because the buyer has some level of certainty that that cash flow is going to continue after the acquisition. And then adding real estate to the deal can really take the multiple down. That's why a lot of times you see the real estate and the business listed separately, because when you own the business, you're just taking out the rent payment. So the actual cash flows can end up the same, even though it appears like you're paying a higher multiple. And we have a really great chart and an article that we'll put in the comments that shows you the multiples for different types of businesses. So keeping to the hair salon example, now a small salon where the owner is actually cutting hair themselves and they're scheduling other employees, you might see a multiple as low as 1 time or less, because essentially you're really just buying a job cutting hair. And now a really large salon with dozens of stylists, a general manager, an assistant manager may trade as high as 4 to 5 times cash flow, because this business can be run almost purely absentee. You can buy lots of them, and it attracts a lot of professional money. So in a way, the smaller the purchase, can almost be more like you're buying a job, versus the larger businesses, those become more investment vehicles, which there's nothing wrong with either one. It just depends on kind of where you are and what you're looking for. So hopefully this helps you think about valuation. And if it didn't, please leave additional questions in the comments and we'll cover that. And let us know if we can help you purchase a business. And if you have any other questions or comments, please leave them here and follow us for more.